Hey folks, here we are. It's the market insights for quarter four, 2025. I've got Jimmy Burns here to my left.
Jeremy, how are you?
I'm doing great. I'm doing great. We're um, slightly later in the quarter for getting this done,
Yep,
but not too bad. It's worth the wait.
absolutely agreed.
So here we go. As always, we theme this out with three different portfolio points. The first being rate cuts and what does it mean for the market performance?
Yep.
And then, is there an AI bubble, an artificial intelligence bubble? That's a question mark. And then year end, we've got some things in taxes, and we've got some things
Oh,
with respect to how the markets typically perform.
my favorite.
There we go. All right. We've seen this slide before. Rate history, the forecast. You know, we've had cuts since September,
Right.
and here we are. The FOMC rate is 3.75 to 4.0.
Yep.
And we estimate there's going to be more.
Yeah, I mean this has been obviously a very interesting time period with the Federal Reserve, right? We have the administration not entirely pleased with the movements or lack thereof from the Federal Reserve. Um, Now they are taking steps towards cutting rates in line with the administration's desires or wishes. So again, been a very unique time, and then we've got the Jerome Powell is going to be done in May of next year. So only a few more meetings left for him at his post as the chair of the Federal Reserve. So very interesting time, and here we are cutting rates. I think you got to remember the dual mandate, right? We have stable prices, and then full employment are the dual mandate.
Yep.
Seems like the prices are not, the right now the labor market, which seems to be softening a little bit, is maybe driving a little bit more of the equation right now.
Well, yeah, I think that's the debate within. So if you look at the Fed board and its governors, there's dissent amongst
Right.
them. They
Yeah.
are not in lockstep right now. And
Yeah.
that's not to say that it's, a
Bad
civil
or
war going on there.
right.
It's just that they're not all on the same page. Some think that inflation is more important to be kind of concerned about. Some feel that you have to have more of a job market take on it all.
Right.
Mohamed El-Erian, who I know you're a fan of, he's now chief economist for
Allianz.
Allianz,
Yeah.
and he's a professor over at Wharton, I think. And he said there's a decoupling of where the markets are going and where the job market is going. And he thinks the gap there is we're on the verge of a great amount of productivity increases
Yeah.
associated with what would you think? Probably
AI.
AI, right?
Right. Exactly.
So it's interesting. You have to at this point kind of separate some things, but I mean by that I mean the economy and
Sure.
the market.
Right.
But nevertheless, they're always intertwined, and this is a great way to kind of sort of forecast where we're going.
Right.
So there we are. It does lead into this next slide. So, okay, we had a pause period, right? We started out with a 50 basis point cut
Mm-hmm.
in September.
Right.
What's the history there forward?
Yeah.
Well, this is what we're seeing here. So you have that first cut, and how does the market perform? Specifically on the left-hand side is the S&P 500, and then on the right side it's 10 years out
Right.
from that cut point. Okay, so we're getting some variance, but
Yeah.
what do you see?
Well, so I knew this slide was coming next, but I was getting ready to say on the previous slide, the mantra of don't fight the Fed, right? So we get these rate cuts, which if you're just thinking about it at a high level, as they're cutting rates, they're reducing the yield that you're able to earn in accounts, right? So now sort of forces folks to reconsider their investment allocation, and when they're able to earn less on their cash or through bonds, it's in theory to promote asset going out and buying stocks, right? So it's not surprising that when we look at the two graphs here, when given the benefit of time over 10 years, that the investment returns look really strong 10 years out from the beginning of a rate cutting cycle. Um, if the Fed were, raising rates, it sort of goes the other way here, and we experienced that in 2022.
Yep.
But here we are, and if we are going to continue cutting, it's oftentimes lined up that down the road you're going to have good stock returns with, in a rate cutting cycle.
Right, and as you know, last month I got an opportunity to go to the Canvas meeting in Texas. Canvas is one of the companies that we use for doing tax loss harvesting, and their chief markets person came up and he was talking about this. And look, the numbers are pretty compelling. 365 days on from that first cut after a paused period, the markets end up about 17% higher.
Yeah.
So I mean, who wouldn't take that type of addition on top of what we've seen here year to date in 2025 and in 2024? Of course, those look great.
Right.
So it's pretty bullish.
Yeah.
There's no doubt about it. It doesn't mean that there's not going to be volatility. I think, in fact, we're going to see increased volatility as a result of some of the changes that are going on right now and some of the moods within the market.
Yeah. And, again, to your point about the markets have been really good in 23, 24, and year-to-date 25. The idea that we're cutting interest rates at, right around all-time highs in the Dow, the NASDAQ, and the S&P 500, I think it has the potential to spook some folks into that bubblish talk, right? If you've already got stock prices at all-time highs and we're cutting rates and we're showing you that the average return 12 months out is 17% higher, and given the benefit of time 10 years, they're all higher, it certainly can lead to believing that maybe that we're in a bit of a bubblish time here.
And that's such a great lead in, because where we're going next is, are we in a bubble?
Yep.
In particular, are we in an artificial intelligence bubble? Because we know that this, if nothing else, has driven the market forward substantially in the last couple of years.
Right. I love the fact that the chart that we're looking at here is looking back at the dot-com bubble, because that really was like the best example of a bubble. Obviously, you had the 2008 crash, the Great Financial Recession, which was more immediate, right? And there were some other things that went along with the dot-com bubble, but I mean, my goodness, the returns that you were experiencing in the late 90s, what was it? Alan Greenspan, he used the term irrational exuberance.
Yes.
Right, around the markets. I think that was still like 3 years before we hit the all-time highs, though, when
Wow.
we made that comment.
Wow.
So that's where bubbles form, and they don't just skyrocket up to the top in some short period of time. It takes a little bit of time for these bubbles to form, but we're looking at very different scenarios here in this graph. The current time compared to the dot-com bubble, very different set of circumstances.
Very different. The author here is from the Capital Group, and his take on it is that yes, he wants people to see that they are different. There might be some similarities, right, but they are different. And part of the reason they're different is that the companies are different too.
Yeah.
There was a lot of IPOs back in that time. And a lot of these companies were highly speculative. They never, ever made money. Right. Some of them did for sure, right?
Yeah.
But they were just a little early to the party, if you want to call it that, in many ways. So that's what led to a lot of this irrational exuberance.
Yes.
A little bit more of a look at this, because we also know in the context of current contemporary market times, we've got the Magnificent Seven stocks, and they've been pushing it forward mostly on the tech play, mostly on the AI trade.
Sure.
And how does that compare to what they called the Four Horsemen back in the day, which was Microsoft, Cisco, Intel, and Dell?
Yeah.
Okay. And so on the left-hand side here, you're seeing, okay, how are those prices compared to the forward earnings per share?
Right.
And again, pretty outsized.
Yeah, you see that big circle there on the chart on the left. Again, to your point, those companies just weren't making money like the companies that we have the potential bubble concerns with right now.
Yeah.
You keep looking at their numbers, and they just we just had tech earnings last week, and they were all really strong earnings. Now there might have been other factors that were reported in their quarterly report that didn't let the stock prices run wild necessarily, but my goodness, these earnings are up year over year, and they're up by quite a significant amount. And they're not just earnings hitting the top line. These companies are carrying them through to the bottom line and maintaining really strong margins. So when you compare the two, you get this big fat circle on the chart on the left showing the gap between the stock price and the earnings. And we do know that over long periods of time, stock prices track earnings, right?
Right.
So this is where you got a bubble where you didn't have the earnings to support the current price levels that they were reaching. But in looking at the chart on the right, where we're looking at the Magnificent Seven, that's a pretty tight line there with the current price relative to the forward-looking earnings projections.
It really is, and you got to. Here's a funny question: Would they have been a lot better off in 2000 with AI?
Right.
Right. I mean, how much is AI actually playing a role in the success that some of these companies are having? I would actually say it's probably having some, even though it's super early.
Right.
In the cycle.
No doubt.
But it's super impressive to see what these companies do, even in spite of all the headwinds that they've faced, whether it be trade and tariffs,
right,
a softening economy. They still continue to perform and put out good numbers.
Absolutely.
So they've done a really good. You have to give them credit where credit is due.
Right.
And many of these companies that are in the S&P 500, in particular the ones that are in the Mag 7, are highly diversified companies.
Right.
So they're not just one trick wonders. It's not pets.com.
Yeah, good example.
It's these are companies that have a lot of moving parts and pieces and a lot of different ways to make money.
Yep, no question.
So, but it's a legitimate question to ask ourselves, where are we at in this cycle, this AI cycle, and when may it create some turbulence for people? Well, again, no crystal ball here.
Right.
If you go back to the author of who was illustrating those slides earlier, he was saying we think he's a couple years out before we have any substantial correction in the AI trade.
Sure. I mean, it's obviously we don't have the crystal ball, so we don't know. But the right now, as we sit here today, the prices seem to be justified by the earnings.
They do, and so then what happens if you're fearing the inevitable?
Yeah.
The change in the market dynamics, the bursting of the so-called bubble, even though we're sort of articulating it's not really a bubble at this point.
Right.
But we know that markets go into bear market territory. It's just a matter of time.
Sure.
How do you deal with that? Well, we go back to our common refrain: make a plan.
Well, this is our favorite, right?
Yeah.
I mean, we obviously are huge advocates for making a plan and to diversify your risk, right? And so if you are somebody that has benefited greatly from owning one or a couple of those Magnificent Seven stocks and you've had a substantial chunk of your portfolio participate in it, this is a great slide to sort of highlight how well diversification can work, and particularly when you start accounting for the amount of risk that you're taking in your portfolio and the return that you would expect. So, we've got the two bars on the right here circled. You got year to date and then 2024. One of the things that jumps out to me looking at this is that you've got, international stocks, both developed markets and emerging markets are currently the best two performing asset classes on the chart here. On the periodic table of returns, year to date, those are the best two. And if you look back to 2024 and you just go back a few years, that light purple that's currently at the top, that was at the bottom, at the very bottom or the second to last, a handful of years going back here. So
yeah.
You never know when these, you never know for sure when these asset classes are going to have their time in the sun. But it's just nice to see that we have seen a little bit of this reversal and some different leadership. Now that all being said, while the S&P 500 and the Nasdaq and the Dow are at all-time highs as we record this here today.
Yeah, great points. You just can't say enough about diversification.
Yeah.
In terms of its how it helps you through the good and the bad, and how do you get to diversification? Well, how do you know whether you're going to be in a 70-30 or 60-40 or whatever it might be?
Right.
Well, that's the plan.
Yep.
Right. So just going back to that for a moment, the way you get to your allocation that builds out something like what you see in white here, which is a 60-40, 60% in stocks, 40% in bonds, you have to have a good plan that's based on you.
Right.
So that's the deepest dive. If we can impress upon people one thing that they need to do, it's build a plan that's very customized and personal to them. And because it's the best way to know what is right for your household. So there we are. Okay. Always a refrain here at On Track. So now we got the last theme of the 2025 Q4 Market Insights, end of year tax planning. We're big in taxes. You're an accountant. We do taxes for many of our clients. We do tax planning for most of our clients. We want to make sure that you take home more money at the end, rather than giving more money to Uncle Sam, right?
Right. Yeah. It's common for us to, are talking of taxes with current clients or prospects is, the importance of it's not so much what you make, it's what you're able to keep, right? And understanding how, going back to that planning conversation, understanding where you're at. There's been some big changes from a tax perspective this year, right? We just had this one big beautiful bill that passed this year, which is going to have some immediate impacts on the 2025 return, but also some that will start applying next year for 2026 and beyond. So there's a lot to be paying attention to on the tax front, and a lot that's changed, and understanding how do those changes impact you now and into the future, and then what could you do based on what we now know that this one big beautiful bill has been passed. What are you in a position to proactively do to make sure that you're not paying more taxes than what you need to?
There's too many things to list.
Yeah.
There's so many moving parts and pieces here, but it's everything from, do I put more or less into my 401k? Do I think about Roth conversions? Do I think about charitable donations this year versus next year?
Right.
All these things you need, but again, you do the plan, you update the plan, and you can see where your taxes are going to go, and you can start to figure not only what's good for this year, but also what's good for future years.
Absolutely.
All right, and to end on a positive note, because history is on our side.
Yep.
Q4 is something that history has been kind to traditionally.
Right.
It's been, out of all the different quarters in the month, it's been the best returner of all.
Get the Santa Claus rally, right?
People love that one. I think it sticks, right? And in particular, November is usually pretty good. December usually ends the year strong.
Right.
We've got sentiment that's possible this year as well.
Yep.
Time will tell, but there certainly are some good feelings for it to continue to end strongly this year.
Right. Well, again, I don't think you should be making any large allocation decisions based on seasonality.
No.
But it is absolutely a factor that should be accounted for when you are doing the plan and figuring out how you want to allocate your assets.
Naturally. So, any other words of wisdom before we sign off here today?
I'm just glad we didn't end on the tax slide.
Yeah, right. I figured, putting those in the right order is always smart, right?
Absolutely.
You want to end on the more positive of all notes.
I like it.
So, if you all want to get in touch with us, we are On Track Wealth Management. We can be reached at hello@ontrackplans.com, and the telephone number's there. We're around. We're open for business. Looking forward to seeing people before the end of the year. Thanks so much for being with us today.
Awesome, Jeremy. Thank you.